All right, today we are diving deep into CapitaLand India Trust, or Clint as you'll hear us call it. We're going to break down their full year 2025 results, looking at it purely from an investor's point of view. What do the numbers really mean? What's the strategy? And what's the outlook for the future?
Okay, Alex, let's not waste any time. Let's get right to the big question on every investor's mind. Bottom line, how did Clint actually do in 2025?
Well, Ben, the headline number is pretty impressive. We're talking about a 15% increase year on year in their distribution per unit.
And just so we're all on the same page, that DPU, or distribution per unit, is really the metric that matters most. Think of it like a dividend for a stock. It's the actual cash that investors get. So seeing a 15% jump in that payout, that's a huge signal.
Exactly right. And a number like that doesn't just happen by accident. So let's dig in a little deeper and see what's actually powering that growth.
And wow, when you look under the hood, the numbers are just as solid across the board. Net property income, that's basically their profit from rent, shot up 16%. Portfolio value is up 19%. Occupancy is strong at 91%. But Ben, the one that really makes you sit up is that last one, a 21% positive rental reversion. Oh, for sure, that one is a showstopper. For everyone listening, what that means is when leases came up for renewal, they managed to increase the rent by an average of 21%. That is huge. It tells you there's incredible demand for their spaces and that they have real pricing power. And that, of course, flows straight down to the bottom line and into investors' pockets.
Right, and that's the thing. This doesn't feel like a fluke or just a good year. According to management, this all comes down to a very specific strategy they have, something they call their 4 growth engines.
Yeah, and you can really see how it all fits together, right? First, you strengthen your current portfolio. You squeeze more efficiency and profit out of what you already have. Exactly. That generates cash, then Engine 2 kicks in. You unlock value by selling off some of those assets to recycle that capital. And that money gets plowed right into Engine 3, the growth pipeline, either developing new properties or acquiring them. It's like this self-perpetuating machine, all held together by that 4th engine, smart capital management.
Okay, so that's the theory, but how does it actually play out in the real world? I think their big move into data centers is the perfect example to look at. And this isn't just us connecting the dots. The CEO himself, Gauri Shankar Nagabhushanam, says it point blank. He credits the strong performance to the momentum they're generating across, and I quote, multiple growth engines. So this is a very deliberate strategy, not some corporate jargon.
So here's a great example. This is their data center project in Navi Mumbai. This is that increased growth pipeline engine in action. But here's the kicker for investors. The first 2 towers are already 100% leased out to a single major global tech company. That is just a massive vote of confidence and takes so much risk off the table for a project this big.
And then boom, engine number 2 kicks in, unlock value. They turned around and sold a small, just over 20% stake in these data centers that are under development. That move alone brought in almost 100 million Singapore dollars. So think about it. They raise a ton of cash to fund more growth, but they still own the vast majority of this incredibly valuable asset. It's just textbook capital recycling.
Okay, that is a really sharp strategy, but all this expansion and development, that costs a lot of money. So the natural next question for many investors is, what about the debt? How solid is the financial foundation holding all of this up?
Well, the key number to look at here is their gearing ratio, and it's sitting at 39.6%, and that is a really healthy number. Gearing is basically a measure of their debt. For these kinds of trusts, the legal limit is usually 50%. So being under 40% means they're in a very comfortable spot. They've still got plenty of room to borrow more if they need to for that growth pipeline we just talked about.
Right. And it's not just about the amount of debt, it's also about how they're managing it. If you look closely, you can see they're making a really strategic shift. They're borrowing more money locally, in Indian rupees, which is what they refer to as onshoring their debt. And this is such a smart move. Let me break down why it matters. When you borrow locally in rupees, you get 2 huge benefits. First, you completely avoid a 15% tax on your interest payments. Second, you can deduct all the interest you pay from your taxes. The bottom line, it lowers their tax bill, which means more cash stays in the business, which, you guessed it, means they can pay out a higher DPU to investors. It's that 4th engine, optimized capital, in action, creating real, tangible value. Okay, so let's recap. We've got a fantastic year behind them, powered by a clear strategy and some really clever financial footwork. So let's turn our attention to the future. What's next for Clint? Well, the pipeline is massive.
I mean, look at these numbers. We're talking about almost 13 million square feet of potential new development in the works. That's a mix of land they already have and deals they've locked in for the future. For an investor, this paints a really clear picture of where future growth is going to come from.
And this isn't just talk, right? It's not just numbers on a page. You can see right here, shovels are in the ground at their tech park in Hyderabad. This shows that they are actively turning those plans into real buildings that will generate real income.
So, Ben, let's bring it all home. We've talked about great results, a really clear 4-part strategy, solid financials, and a huge pipeline. If you had to sum it all up in one key takeaway for an investor listening right now, what would you say?
I think the biggest thing is that this success doesn't feel random. It's not a one-off good year. It really feels like the direct result of that disciplined, repeatable 4-part strategy we've been talking about. They improve their assets, recycle the cash, fuel new growth, and keep their finances in check. It's a clear formula, and from an investor's point of view, it's a formula that is clearly working.
This content is intended to serve strictly and only as an informational, independent, objective summary of recent events, and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.